Cut your losses short. Every trading book repeats this. Every coach drills it. It's correct advice. Taken too literally, it produces death by 1,000 whipsaws. Traders interpret cut short to mean set the tightest possible stop. 15 cents below entry, 20 cents, whatever feels small. Normal market noise blows through that stop on every trade. They lose 15 cents 20 times in a row, and they don't understand why a strategy with 60% paper win rate is bleeding money. Today, the volatility-aware stop rule that balances loss limitation with breathing room, why position sizing matters more than stop tightness, and the math that turns cut losses short into productive discipline instead of self-sabotage. Here's the framework. A stop too tight gets hunted by normal noise. A single bar's average range takes you out. A stop too wide makes one loss large enough to wipe weeks of progress. The right stop sits outside normal noise, 180R, the 14-period average true range, below structural support. That places it beyond the algorithm's typical sweep range. Then, to keep your dollar risk constant despite the wider stop, you size down the position. Same 1% of account at risk per trade with a stop that actually survives normal volatility. Right stop, right size. The cliché cut losses short doesn't tell you to set the tightest stop, it tells you to limit the dollar loss, which you do with sizing, not with stop placement. Watch this in a synthetic uptrend. A trader sees a clean uptrend, enters long with a stop 15 cents below entry, cutting losses short. Within bars, they're stopped out, normal intrabar noise hit 15 cents. They re-enter, stopped out again, re-enter, stopped out again. Over 20 bars, they're stopped 7 times in a row while the trend marches up. The setup was correct, the direction was correct, the stop was too tight to survive the chart's normal breathing pattern. 7 small losses they didn't have to take. The trader concludes the strategy doesn't work, but the strategy was fine. The stop placement was the entire problem. Here's the rule. Place your stop 180 or below the structural support level, not at the support, below it by a full volatility unit. That puts the stop outside the zone where normal noise lives. To compensate for the wider stop, calculate position size down, same dollar risk, fewer shares, wider per share loss tolerance. Total risk to account stays the same. Survival rate of individual trades goes up dramatically. You haven't violated cut losses short, you've cut losses short by sizing, not by tightening the stop into the noise zone. Now with the AT, buffer and size down position. Same trade, but stop now sits 180 or below the prior swing low, well below the noise zone. Position size adjusted down so the wider dollar stop still represents 1% of account. Normal intrabar volatility doesn't touch the stop. The trader stays in the trade through the same swings that whipsawed the previous setup. Trade extends with the trend. Exit at structural target, full move captured. Same chart, same edge, completely different outcome, driven entirely by giving the stop room to breathe while keeping the dollar risk identical. In real practice, the workflow is mechanical. Calculate the 14-period AT on your time frame. Place your stop 180 or below the chart's structural support, usually a swing low or a moving average. Calculate position size by dividing account dollar risk by the per share stop distance. The math gives you a smaller share count than the textbook tight stop trader uses. The trade tolerates the noise that destroys them. Cut losses short becomes a dollar rule, not a cent rule, and the cent rule is what creates whipsaws. So cut losses short is correct advice that becomes destructive when interpreted as set the tightest possible stop. Place stops outside normal volatility, 180 or below structural support, and size position down to keep dollar risk constant. The whipsaws stop, the same setups produce dramatically better win rates, and the dollar discipline is preserved without forcing the cent-level discipline that destroys trades. Subscribe for the full method and trade your own plan. Education, not financial advice.